Pius, as we saw the market falling back 1.8%, as I said, falling to a fresh 20-month low, notably banks on the losing end yesterday. But of course, it's been a broad-based sell-off for the past few sessions. Just give us your take on what's taking place in the market. Will there be any respite for the Kenyan market in the coming few weeks?
Well, Samantha, what is really happening here is a macro story. We have weakening macroeconomic conditions in Kenya, and now also we have an issue of global economic concerns that are also coming and affecting Kenya. These are not things that can really be resolved overnight, and therefore I really expect that this bearish trend will continue persisting. However, we may see opportunistic and very selective buying from especially foreigners to take advantage of rock bottom prices, and what is really seemingly increasingly attractive dividend yields.
That being said, though, Pius, of course, the concern now is what's taking place in the global environment, and some coming out saying that the developed world is headed for a mild recession. If that is the case, and you are of this view that it could have implications for companies in Kenya that are reliant on demand from the developed world, for example, the exporters and perhaps luxury hotel groups like TPS Serena, what would your portfolio positioning be with companies like this?
Well, really, what my take here is that the cheese has moved. Inflation is now at 16.7%. It's 3 times more than what the CBK target rate is, which is 5%. With this sort of environment, then you expect people to scale down their equities, especially the ones which are susceptible to global economic environment, and allocate more to cash. For example, what we are seeing right now is that the 91-day Treasury bill, the auction yesterday, it was at 10.2%, and we only expect the 182-day and the 364-day Treasury bills also to continue edging upwards. The overnight rate is now at 17%. Call deposits are also double digits. With this sort of return on cash, then you can only expect the cash investments in cash to outperform investments at the equities.
Now, one of the stocks that has been under considerable pressure since releasing its numbers for the first half of the year is Express Kenya. That stock plunging yesterday, one of the top losers on the day. It reported a 42% plunge in revenues as a result of the loss of its contract with East African Breweries, and that put it into a loss-making position of 55 million shillings for the first half of the year. With the company now planning on selling a non-core asset and no sight of a new big client to replace a company like Ebel, are there any prospects for a turnaround in Express Kenya in the near term?
As an investor, I'm very curious to see how they are going to not only replace this very major client that has left their portfolio, but also how they're going to handle concentration risk that has been there in the past. If you look at the stock at the moment, it's trading, is actually the cheapest stock in the stock market, with a market cap of about $1.5 million, which is really investors who are expressing themselves saying that they have concerns about the future prospects, future earnings prospects of the company. So there is a lot that needs to come from the management to make it clear to investors on its future prospects.
But you'd be staying away from a company like this at this stage?
I wouldn't say exactly that.
Let's move on. British American Investment has postponed the listing of its shares on the stock exchange to next week. That IPO we know was undersubscribed. Any reasoning for this listing being postponed?
I think I don't have very specific reasons for that, but the reason for undersubscription was really because of the general bearish environment that we are in. People are scaling down on equities, and this IPO was done in this sort of environment. So I think even 50–60% was still not too bad.
Now, Mumias, another stock that was punished on the exchange yesterday, falling 5.5% to just over 6 shillings. Investors initially liking the numbers, though, that came through for the full year for the company. It reported profits rising 23%. That helped by rising exports, increased efficiency, and of course the sky-high sugar prices that we're seeing in the region. Is there any reason for the stock falling back now?
I think we need to detach what is happening at the stock exchange, the falling in the share prices and performance. This is something that is not discriminative to any particular stock. I expect the company to continue performing well as long as the global sugar prices remain high. Of course, there's a small concern that the government will be lifting up its protection on the sector in 2012. However, the Comesa region is really a net importer of sugar, and that could also act as a cushion on the company. Also, with the Kenya shilling at one of its weakest points, then you expect sugar imports to also be expensive. With a PE of about 4.8 times and
a dividend yield of what, 8.2%?
Of almost 8%. It's looking speculatively cheap.
And also, the company is stating, given its leadership, given its leading position in the country, that it's looking to possibly buy up as smaller players. So it is looking at consolidating its market share in the state.
Yes, there is information that is coming to the market that is looking to buy its rival state-owned sugar companies. And this really is a step that they're taking towards enjoying larger economies of scale and bring down their production cost.